Thank you very much, everyone, for joining us. It's a real pleasure to have you all here. I'm very excited for what we're going to discuss because we're getting to a moment now where the discussion around the transition is not just about wind and solar. So all of a sudden, industry has a mandate to decarbonize, and that means we're talking about things that are earlier stage, like hydrogen, CCS. And all of those projects are going to have to move much faster than we've seen anything move in the past because of this 2050 net zero deadline. So I'm going to start with Gavin and Dan, and I'd like to ask the two of you about the Inflation Reduction Act. We're about a year and a half out from it. I want to know, has it changed your businesses, how you're working, and how would you contrast it with the bipartisan infrastructure law? Are the grants there actually going to have a bigger impact? So maybe I can start with Gavin.
Look, I think when the IRA came out, it created a tremendous amount of excitement and momentum that's out there in the market. And you can see just on the sheer number of project proposals that was generated that was taking some time. Now, I also think that's working its way through the system now. And, you know, the amount of that and how it's being applied is going into a pipeline. So certainly, if you think about a pipeline and a funnel, it loaded it up. Maybe there's some of the restrictions that are in place and how it's being implemented and the capability to deploy it are making that pipeline a little smaller in reality that was first envisaged. But certainly, it's created a bit of a push and momentum in the industry around some of these key topics. That's
absolutely. So seeing a lot more momentum, a lot more announcements. Dan, would you say something similar?
Yeah, I would absolutely agree with that, Julie. I mean, we have always said it's going to take two things to make this take off. One, we've got to get technology innovation to get the cost down. But we also need a market to develop for a low carbon business. And right now, we need policy support to help that market take off. And so really happy with the intent of both the IRA and the bipartisan infrastructure law to incentivize that type of innovation, incentivize that investment to get things going. So we think that has been the right intent. And I think there's some good examples. So with the IRA, take 45Q, and that change and that increase in the production tax credit for carbon capture and sequestration effectively doubled the addressable market available for CCS in the US. So fantastic and aligned with the intent. 45V, also the right intent, and getting the approach to low carbon hydrogen really focused on the carbon intensity. Technology neutral, feedstock neutral, but focused on lowest carbon intensity. We have some clarity we still need on the rules with 45V. I know that's a lot of area of discussion. The intent is right. We need to get better clarity on the rules for 45V.
Absolutely. So doubling the market for CCS, that's huge, but more details needed before we can really see it leveraged. Stuart and David, you're coming at this from a different angle. Stuart from the Loan Programs Office, David thinking about startups. Has this meant it's boom time for you guys? Is it super easy to source deals? You're drowning in them? David, maybe I can start with you.
Drowning in them, yeah, that's it does feel like there's a lot out there, I'll be honest. Certainly when you think the companies that raised in 21 and 22 typically coming back to the market 18 to 24 months later. Also, if you look at the macro last year, a number of companies that probably should have been raising that didn't, chose to go inside and do bridge rounds and smaller internal rounds, they'll definitely be coming back to the market this year. I think they were hoping for a more favorable macro. We'll see. I think last year was characterized by, flat round is the new up. I think this year will be characterized by down is the new flat. I think we're seeing more structure come in, but there's no, there's a lot of deals out there. We're probably viewing about 150 deals a quarter, but we're very intentional about where we invest, where we want to deploy capital. Similar to Stuart, we have a pretty high bar where our growth equity for that last valley of death is actually appropriate.
So being very selective about those deals, but definitely seeing a lot of them.
There's a lot to look at, but the flight to quality, I think, is what we should call it.
Absolutely. Stuart, what's the view from the government?
We certainly see a lot of deals. Since the IRA effectively put a zero on the end of our capability for loans, we went from about $40 billion to theoretically $400 billion sort of top-level loan authority. It's a lot of capital, and our deployment minimum threshold is about $100 million or more. So you've got to be at a level of maturity as a company where you can deploy significant dollars to create a commercial outcome. We're debt, and we need to be paid back. So we underwrite cautiously and carefully on the basis that we'll be paid back. So we've seen a lot of extra applicants come through, for sure. We field multiples per day, each of us in the outreach group of Loan Programs Office. But we try and filter them down to companies that we see have the right characteristics in place to perform, execute, and deploy on a scaled project that will reasonably be able to pay us back. And those are the criteria, and we're seeing a lot of opportunity. It's a space where most of your large-scale projects are at the very beginning of their learning curve, first-of-a-kind funding. It's right at the beginning where margins and returns are very, very skinny. So, you need to be able to leverage it in some way to create an outcome that's useful for private equity.
Mm-hmm. Makes sense. So I'm hearing there's a lot of opportunities now. There are some high-quality deals out there, but it's just, the IRA has actually catalyzed the change that it was meant to. So there's a policymaker out there who's very happy. There are a lot of people in the room who I'm sure want to work with each of you. So my next question is about what really makes a good project or pitch. Like when you're thinking about this is definitely the deal or project that I want to do, what does that look like? And Gavin, maybe I'll start with you.
Yeah, I mean, look, we've always said our role is as a technology company, right? And so for us, when I think about it, we think about projects, we think about it in the context of what's the technology that needs to be brought to bear. Dan hinted at it, I think, on his first comment. Either it's going to enable something that doesn't exist today and create a market, or it's going to materially shift the economics of a market that already exists. So that's our first stage gate, is we really look at it and say, okay, does it fulfill those criteria, and does it fulfill the criteria we have in terms of impact, in terms of emissions, and in terms of do we think that this can be a viable business or the business model long term? So we go through that piece. The second thing we say is, let's look around, is there a customer? Who's willing to work with us on this, right? And are they going to receive the benefit of it? Is it going to make sense for their business context to be involved in this? And that's a bit of a litmus test, because in a short period of time you can gauge the level of engagement that you have. And then the third thing we say is, how fast can we make it scale so that it's material? Can we have a material impact globally? Is it only confined to certain markets? What's the level of scalability that we can do with this? And just as you go through that process, the conversations that you have lead you to understand the types of projects that you're likely to get involved in technology. So certainly from the perspective we have, where we are trying to deploy our capital into technology development, not necessarily into projects or assets, that's the approach that we take.
Great, so it sounds like something that is going to bring a step change along with it at some point. Dan, how is that different for you? What do you look for?
It is actually very similar for ExxonMobil, and I guess I start with, when we think about what projects, we start with what businesses and what technologies we want to participate in. And the lens we look through is, where do we have something unique in terms of capabilities that we can bring to solve the problem? And so that lens is how we've picked the particular businesses that we're progressing in our low carbon solutions business. So if you think about what ExxonMobil has done in our traditional businesses, our knowledge of the subsurface, upstream capabilities, chemical manufacturing, those type of capabilities, how do we bring them to the low carbon business? And that's led us to carbon capture and sequestration, hydrogen, biofuels, and now more recently, lithium. It's about bringing our capabilities to those businesses, and that's how we approach it.
Absolutely. So finding ways to play to your strengths makes a lot of sense. Stuart, I'm sure everyone's going to be hanging on this answer. What are you looking for?
So we're technology agnostic. We're a qualification or eligibility-based program, meaning we don't have a bias towards what type of technology that comes in, and we don't try and emphasize one over the other. We're essentially looking for projects that can catalyze a change. And the primary goal of the Loan Programs Office is to be first of a kind, second of a kind, nth is a small number of a kind, to enable the sector that we're looking at to start to be securitizable. So pulling in enough capital, crowding in private capital to the point where we've reached maybe $100 billion in any particular sector. At that point, we'll say, yeah, we're now securitizable and Wall Street can take over from there. So we're not trying to get specific technologies through the door. But when we're looking at a technology, we'd like to see a few things. We're effectively project finance, and I'll emphasize again, we expect to be paid back. But we've got, again, theoretically $400 billion that we can deploy. Our loan to cost is up to 80%. Our interest rates are Treasury plus 3/8. It's very attractive capital. And we can do this for up to 35 years. So we're looking for certain characterizations. First of all, we need a meaningful scale of project. So when you come to us, really it's 100 million plus, and realistically it's 200, 300, 400 million plus now, because we have such quality and opportunity that really to attract the attention, the bigger the better. Deploy at scale. So that's sort of the first thing, is it a good quality project? It's got to be in the US, that's one of our criteria. And then we'll look at any typical project financing criteria. The first one is feedstock. What's coming in? What are you converting? What are you working with? Do you have a long-term contract on that, or do you have very great security of that supply? That takes care of the feedstock. Then the build. What are you building? How are you building? Who's your EPC? Is the confidence, has it been done before? Is there a wrap around it? Is there insurance with it? Can we be confident that we're not taking on the risk of construction? And then, of course, is offtake. What are you building? This is a SAF plant. We've got to sell a SAF forward, right? Have you got a forward contract with a creditworthy counterparty that's going to buy your output for the next 10 years at a price that allows you to pay us back, service the debt, and make a profit? So have you taken all of those risks off the table? And then the last one, of course, is one that I think anybody in lending, in private equity, private credit, looks at in the same way. Who's the management team? Have you done this before? Do you have the competence? Do you understand what you're looking for? Do you know what project finance is? Seems a bit trite to say that, but we're a different breed. Do you know what project finance is? Do you know how to work with it? So if you can get those four key things right, people, offtake, build, and feedstock, then you've got a really viable project, and come see me.
You're not asking for much then. David, you look at something very different from any of the huge projects that we've just talked about. You're looking at startups. What do you look for from them?
It's actually very similar, but maybe a stage or two earlier than Gavin and Stuart's point. So we won't invest at the project. We'll only invest at topco equity. But we do characterize ourselves as late venture, early growth, so typical Series C, Series D investment round, really where we're the last valley of death. That's the valley we're tackling. We're looking to invest where the first commercial plant can get built. So I think a lot of the stuff that's already been mentioned, technology that's proven, ready to scale, desperate customers, lined up, round the block, ready to take off the whatever you're producing or interact with you in whatever way you need. Even if you can't have revenue today, we need to see that banked for the future. And then the point made, management teams. The risk we're taking is execution risk. That is team risk, that's people risk. You're investing in the people. What's their track record? Have they done this before? What's their capability? How are they willing to work with others in the industry to try and get their project to scale? So we ask for a lot as well, but we're just a little bit earlier. We'll take a little bit more risk.
I think that makes sense. Definitely the importance, and we were talking about this backstage, of like seeing people face to face, meeting people, like being in a place like Houston. It's so important.
Absolutely.
I want to talk a little bit now about first-of-a-kind projects. That's what we're all meant to be discussing. So I wanted to speak to you, Gavin and Dan, about your projects. Are very many of them actually first-of-a-kind? How comfortable are you with those sorts of projects? Dan, do you want to go ahead?
Yeah, well, I would go back to the type of projects that we're investing in may be new technologies, they may be first of a kind in a new market, but they're building on existing capabilities that we have. And that's part of how we think about de-risking all this. So as an example, take our Baytown low carbon hydrogen project. What we're looking to do is have the world's largest low carbon hydrogen plant. And that will be something new. However, it will be integrated with our site at Baytown. It builds on the existing facilities we have at Baytown. It builds on the existing know-how with the chemical and refining that we have there. And so that's part of how we're confident we can de-risk that project. That's one example. Another example is lithium, which takes together different components of our capabilities and brings them together. And so lithium is not new. There's an established market for lithium. But what we're doing is new, which is direct lithium extraction from deep brines in the Smackover Basin in Arkansas. We can de-risk that because, number one, when you look at the upstream capabilities we have, bringing to the drilling, the wells, the subsurface expertise, that's part of it. The DLE processing, very similar to our chemical manufacturing. So that gives you a sense of how we look at putting together the pieces of our capabilities and using that to de-risk some of these first-of-a-kind projects.
Those are two fascinating projects and really interesting to see how they're going to grow. Gavin, Dan brought up de-risking. That's a huge part of any first-of-a-kind project. How do you think about that with yours?
Yeah, we've got more first-of-a-kinds going on now than I can poke a stick at. And I think that Dan's way of describing it is quite good. There are two sorts, really, if you broadly look at it. Do we have some existing technology that needs to be incrementally modified or developed and used in a different market? And that's true for geothermal subsurface. It's true for carbon storage subsurface, for instance. Or are you bringing something that's really a new technology to the table and creating something different? And so we have, much like Dan, we've focused on lithium. We have one in Nevada that's being built and is in commissioning at the moment. We have two different hydrogen technologies that we're working on in different parts of the world with customers and use cases to be able to develop them out. We have three different projects with new carbon capture technologies, be it being deployed in a paper mill or a coal plant or a cement plant, where we have a new use case with a new technology that we're trying to prove that can shift economics in a big way. And so there is tremendous capacity for technology to have an impact on this space. But those first-of-a-kind projects are first-of-a-kind, and you're learning and you're de-risking, and you have to work in a really open, transparent, agile way, understanding how you will react if things don't go right. And to the point about managing risk, I say to my boss, I need to be 100% convinced that all of these are going to succeed, and you should expect that several of them will fail. All right, and that's the kind of mentality that you have to bring to the table. It's a little bit akin to some of the way the tech industry thinks. You really have to go all in if we're going to have the kind of impact that we want to have. But I certainly feel that across the next 5-10 years, there will be many companies, and certainly we will be really trying to do these things and not just do them, a test on a bench. Do something at a scale that makes it meaningful for an industry and to have impact. And that's a really important thing. And I was very encouraged at some of those comments earlier.
Yeah, I think what I'm hearing is when the payoff is potentially so great, then you find a way to manage the risks. You build on the capabilities that you have. And so long as you know where you're headed, then it's all able to be done. I want to also have a follow-up for both of you, and that is on the financing of this. We've heard that a lot of people are, nervous about doing something that's absolutely first. They want to finance the 10th, the 20th. How do you both deal with that?
Well, we look at our capability to fund our projects from our balance sheet primarily. That said, we will always look at all sorts of funding strategies for projects as we develop them, not just low carbon, but more projects in general. But where the business is now, we're happy about our ability to fund from our balance sheet. Our plan that we've announced is to invest $20 billion by 2027 in lower emissions solutions, half of that for decarbonizing our own facilities, and about half of that to decarbonize third parties.
That's fascinating. It's amazing to see that split as well between your own operations and other companies, because it's a great way of using all that expertise for the industries that maybe don't have the footprint that you do in hydrogen and CCS. It's very interesting. Gavin?
Yeah, I think we'd think about it through a couple of channels. Number one, obviously we have skin in the game because we believe in it to some extent ourselves. Ideally, you are involved with a customer. Yeah, and in many of these, sometimes it's an end-use customer, sometimes it's an intermediate customer. I think there was a recent, thank you to the DOE, announcement about some grants that we were awarded for a paper mill in Mississippi. And so you have Amazon as the end customer of the products from the paper mill that's going to get the benefit of that on their sustainability agenda. You have the paper mill itself that wants to decarbonize. You have a technology company that we work with to develop technology, and then you have us as a deployment mechanism. So and then you have the DOE that's happy to help with grants, in this case, de-risking the actual use case and the project because it opens up a new industry. So there's a few different channels there. The other thing is you have a customer with a big balance sheet. Like the person sitting next to me that believes in it as much as you do and wants to take it forward. And then of course there's the ability to get the government to help in some of these places, and whether that's at an early stage technology development or at a scaled project level, which I think is what you were referring to earlier, both are really important. And I do think that you need those combinations. In fact, there is a healthy balance in investment combinations that helps you to get to a good outcome that I think is really valuable when you look at financing some of these projects. And I do think the finance community needs to think about, I think there's a lot of really good structure around very early stage investments. I think we refer to it as the value of debt. There's a good structure, as Stuart pointed out, on project scale above $100 million. The place that it becomes the most interesting is when you want to build that first really scaled pilot, or there's a ton of people lining up to do the second project. But the first one, you have to search around a little bit sometimes to make sure that you get the right partnership combinations to do that.
Yep, so get a little creative, line up all your partners, and then get a little help from your many friends. It sounds tough, but I have every confidence in you guys. I want to talk now about the different technologies and sectors. David, you've mentioned the startups, the early stage work. You also do growth equity. So I'm really interested to hear where in this scary, hard-to-abate sector of new technologies you're finding some growth equity.
It's a good question. And I think first let's level set, because I think there's a lot of folk throwing out that we do growth investing with sort of $100 million funds investing in software. It's fine. We define growth very narrowly, I think. So proven technology ready to scale is one of the taglines, and that means we won't fund a pilot, we won't fund a demonstration facility, we will fund that first commercial scale, industrial scale facility with our expensive venture equity. Second is the desperate customer that I mentioned. So there has to be revenue, or if not revenue, at least a commitment for revenue. I think once you then sort of narrow down the field of what technologies can fit within that, it isn't any one sector particularly. I mean, obviously there are some that are off limits, so you can't do fusion with that mandate right now. But SAF, advanced mobility, energy storage, they're all within within scope, I would say. We found a lot within advanced mobility is the broad category, so electrification of transport, but we see it from a land, sea, and air perspective, but we also see it from a value chain perspective. So two companies we've invested in. One is Group 14, which is a silicon anode. It's the same cost as a traditional anode for a battery. It's a 40% greater energy density, so 40% extra range. We're scaling manufacturing right now. The technology is proven. We're now just building the first manufacturing facility. Similarly, Ascend Elements, which is an end-of-life battery company, so it takes the black mass or the end-of-life batteries, produces precursor cathode active material or cathode active material from that. They've had 2 pilots running for a number of years. They've had a small-scale commercial facility running for a period of time, and they're now building that first-of-kind facility. So I don't think it's any particular sector or any particular technology that's ready for growth. You've got to find your way or navigate your way to the company that has a fit-for-purpose solution that's building that solution that you want to take to market.
That's really interesting. And having looked at a lot of early stage technologies and seen so many of them fall into that chasm between pilot and truly commercial, it's very cool to see someone working specifically in that space. Stuart, I'm going to skip to you, and I'm really interested to know where you are seeing all of these projects coming from. Is it a particular technology? Is it a particular sector? Do you look for a mix of projects to maintain them?
So the answer is yes and no. We have a lot of different sectors that come for an application, of course. I'm here in Houston. You guys are all familiar with the technology that allows geothermal, that allows carbon capture, sequestration, transportation. These are all midstream, downstream, upstream qualifications. Hydrogen, clean hydrogen is most of the hydrogen in this country is made through SMR. It's for ammonia, it's for diesel desulfurization, etc. You can clean that by capturing the CO2 and doing something else with it. So this room probably represents the sort of epicenter of where these types of technologies can be deployed at scale and where we have the wherewithal to do it. But we also get, the broad spectrum of technologies. Nuclear, for instance, we had a large investment in the Vogtle nuclear plant that came on stream a year or so ago. That's Train 3. 2.5 times over budget, took a lot longer than expected. Train 4 is coming on soon, 30% cheaper, better recognized, better understood. So there's a learning curve in that deployment, plus there's now something like 13,000 trained workers that understand how to construct, operate these types of facilities. Batteries, you talk about batteries a little bit. We fully expect now to be self-sufficient as a country by 2030 for EV batteries. There's so much going on in that space, and we're involved in quite a lot of those projects. So it's really across the spectrum. We track 17 different technology sectors, each of which we believe has to get up to this $100 billion in asset class value to be properly securitized. And we've got projects coming from everywhere. I particularly enjoy the projects that come in from Houston. I spend a lot of my time focused on those because typically, when we get a carbon capture project that's coming from California, my expectation is fairly slim that it's going to be executed. When I get one coming in from Houston with an oil company that knows what they're doing, my expectation, is very different. Dan's not going to sit there and tell us that Exxon is going to do A and then they won't do it, right? It's going to happen. So it's just a very different mentality.
Yeah, that's interesting. I'm glad that we're still talking about lithium. I started out my BNF career as a battery analyst, so nice to see I'm still talking about it on stage. I'm going to give you a few minutes now to complain. So I want to know from each of you, what is your biggest roadblock? What's really stopping you right now? And David, I'll start with you and we can run down the line.
So we don't underwrite to green premiums in the investments we make. So we don't believe in that there should be a premium just because it's sustainable or a low carbon technology. That being said, in order for us to get there, I think there has to be some willingness to pay to help get a technology brought to market. So while I think the entrepreneurs and the scientists and engineers can focus on that first point of proving the technology, that desperate customer point feels like it's a little bit sluggish in getting folk where, and I'll just take SAF as an example. If you're an airline and the vast majority of your emissions are coming from the fuel that you burn, wanting to transition to a lower carbon future without paying slightly more for a gallon of jet fuel, that's kind of hard for us as an investor to underwrite to, and really hard to see how those projects are going to get built. So I think that desperate customer and willing to sort of short-term time box premiums might be a bugbear of mine.
Demand side, always a problem.
Yeah.
Dan, what's keeping you up at night?
Well, I agree with the same theme that David described. And so back to what I described earlier, we've got to get the costs down, technology, scale, innovation, and we have to have a market developed for this. So there has to be a willingness to pay, and in the absence of that, policy to support this thing taking off. So that is the big one for us. And I would say very practically for the policy with our projects, I would say right now it's that clarity on 45V that I described. And so that's a great example of how we can unlock getting this thing started. And so with 45V, getting better clarity on, for example, the carbon intensity of the natural gas feedstock going into low carbon hydrogen. That's a very specific answer to your question, Julia, but it gets to the same theme from a macro perspective that David is describing.
Absolutely. We love detailed answers at a BNF conference. Gavin, what are your thoughts?
Look, I think we opened a little bit with it. It's regulation or implementation of some of the schemes that are really good that are out there that incentivizes the outcome we're trying to achieve, not necessarily the method by the way that you get there. And I think that's really important because it is actually slowing things down right now. So you need to know, much as Stuart described, you need to know the landscape you're investing in. You need to know it's going to be there long enough. It's not useful to have an incentive that lasts for 10 years when a typical project's going to be justified over 20. And then, we run into, I'll give you a couple of good examples. I mean, I think everybody on stage could talk about 45V and how that is likely or biased in one direction or another. But even in batteries, you raised that. I mean, the legislation around what are the technical requirements for a battery to meet manufacturing credits for it right now are designed around a very narrow window of lithium. So if you come to the table with a new technology that somehow falls outside of that, but may have fantastic use cases, may debottleneck the renewable penetration 5 years from now in an advanced markets, it somehow doesn't fit those rules. And I think we need to get to a point where really we are looking at an outcome-based impact in the way that some of these regulations are being implemented, and that might be the type of way you generate hydrogen in a low carbon way or anything else in the space. So I think that's a big something that I worry that there's a lot of financial capability, there's technical capability, and there's actually building project deployment capability, but some of these things can be the rug that trips us up.
Very interesting. Stuart?
I think it's really about deployment. We've all touched on the efficiency, the economy of scale, the learning curve, getting better. But until the first company has done the first of a kind, you're not going to even start down that path. And we look at a lot of projects that seemingly have great merit, but until you've actually started to deploy a few, it's really hard to determine the direction of that learning and the direction of that efficiency and where it's going to go from. So as an example, we have a half a dozen CCUS projects in the US at the moment. We probably have 100 plus announcements. Most of those will probably never see the light of day, but those announcements crowd out reality of execution. And particularly when it's something like an emitter is committing their carbon to a transport facility, a pipeline, who is committing to a hub of Class 6 wells, that chain has to be tight. Everybody has to be committed. There have to be contracts in place. And if you've got 10 different companies boasting the same facility, route, capability, no one's going to get anything done. So to me, it's about deployment. It's let's get stuff done. Till you do that, it's not worth talking about.
That's a great phrase, the reality of execution. We're running really short on time, so I want to ask everyone about policy risk. Obviously, this is an election year. There could be huge changes. You've all mentioned policy as something that's important or that is part of your roadblock. Stuart, I'm afraid I'm going to go back to you first, since you're from the government. These first-of-a-kind technologies, do you think they can survive on their own merits without policy support?
So the loans that we put out, as I said before, need a reasonable prospect of repayment, which means there's got to be a facility to sell your product. There's got to be a capability to deploy. A lot of this, yes, comes down to tax credits that are written into law. There are two things that will happen, in my view, and let me take my DOE hat off. This is my opinion. The Loan Programs Office has lent money to projects throughout different administrations since George Bush. Right? So the program was set up in 2005. We put out loans in 2008, 9, through Obama, through Trump. And now we've obviously been supercharged. We have a lot more capability. We'll put a lot more loans out. We create very good, high-quality jobs in red states and blue states. So I think this will continue. Everybody wants to be on the front end of technology. We're in the process repatriating the capability to manufacture stuff. Remember, the US, we stopped doing stuff. We stopped manufacturing 40 years ago and offshored all that stuff. We invented it all and offshored it. Now that's coming back, which is a great thing. It's great to have that capability returning here, and it's happening at scale. So I think that it will continue. I think that all of these projects that we're working in first of a kind will continue. I think there's some great technologies being created, and they will eventually stand on their own as economic units and economic outcomes that don't rely on, let's say, tax breaks to be successful. Carbon, how do you sequester carbon without a tax break? Well, it's got to be recognized as a waste product. There's got to be a cost to that waste product you're manufacturing. So, I think eventually society will take over these kinds of outcomes, and, the projects will continue. I'm very optimistic.
That's good. I'm glad to hear it. Gavin, what are your thoughts on?
I think it needs to be smart. Right, and I mean, I'm going to say this obviously because we're a technology company, but it's also because what I believe in our focus. What we're trying to do is move very fast through a transition, as fast as we can go. And to do that, the policy, it needs to incentivize what are the roadblocks to progress. I think one of the stats that was out there was about $670 billion in investment in renewables in the last year, and less than 10 in industrial decarbonization. And if you look at the impact that's likely to have, that's kind of an important scale of things. So I think being able to have flexibility in policy going faster with new things intrinsically involves taking more risk. And that might be the government taking more risk, or it might be private enterprise taking more risk along the way. And we're all in this. But I really think that we are still in the infancy of modifying policy so that it can be really smart and specific and brought to bear in the most effective way. And for me, that needs to shake out across the next few years, regardless of what is happening in the political spectrum, in order for us to move forward.
Absolutely, makes sense. Dan, how do you think about the policy risk?
Well, I don't think building a business for the long term on government subsidies is a good long-term strategy. But the reality is we have to get started, and the market needs to develop, but we've got to get started. We've got to get technology deployed. We've got to get the cost down. I think the businesses are also in different parts of their market evolution. So on one side of this, look at the lithium market, which is established. There is policy support indirectly for lithium. If you look at, for example, in the US, 30D with the IRA, EV tax credits, there are some policy support for EV development, which is pulling lithium through the chain. But you can see a path to a market-based approach for lithium. And so we need to get there. We need to get the technology down. Same for the other businesses. And I think having ultimately a market price on carbon, one that is transparent, one that is technology neutral. That's ultimately what we're going to need in order to make this work.
David, we talked about this a little in our prep. Do you think these industries can survive without subsidies?
I think we have to believe they can survive once they get to scale. As I say, we don't underwrite long-term to green premiums, or we have to see a path to parity on cost. But I think if we're trying to accelerate this transition over a time frame that we to live within our carbon budget, then it probably means we need to give these a bit of a leg up. Like, I spent 20 years in finance at an oil and gas company before this, and there are still levels of subsidy that exist in conventional industry today. I don't think it's too out there to suggest that we probably need to subsidize the next generation of technologies that are going to see us through into the next sort of 100 years.
Absolutely. Well, we're over time. I've kept you from lunch. I'm surprised Shira hasn't chased me off the stage yet. But thank you so much to everyone for being on the panel. It's been really interesting. To the audience, I had a ton of really detailed hydrogen and CCS questions to ask these guys, so they're ready. Get them in the lunch break and you can have your answers. But thank you very much.